Imagine for a second you're running a massive global logistics operation, and you need to move a product from, point A to point B. But this product isn't.
Hmm?
It's not microchips. It's not pharmaceuticals. It's heavy. We're talking dense, heavy metal bars, tons of them. Now, the standard way to do this, the normal way, is pretty simple. You put it on a massive ship and let it drift across the ocean because it's cheap.
I mean,
Yeah.
that's logistics 101. You don't put bricks on a plane. It just kills your profit margin.
Exact. Or, well, at least that's how it's supposed to work in a normal world. But then all of a sudden you stop doing that. You get so desperate to get your hands on this metal that you start chartering cargo planes. You're willingly paying this huge margin-crushing premium to fly heavy bullion through the sky.
Just to get it a few weeks faster.
Yeah, just to shave off a few weeks.
That sounds like a panic move. It sounds like something is fundamentally broken.
That is exactly where we're starting today. Welcome back to the Deep Dive. We are unpacking a pretty wild set of events that all came together yesterday, January 27th, 2026. And if you've been kind of ignoring the silver market, maybe because you think it's just a boring industrial metal, you really need to pay attention to this.
We're looking at what I think is a historic convergence of signals. It really suggests the global supply chain for this metal is, well, it's hitting a wall.
Hitting a wall might even be an understatement.
It might be. We're analyzing two major market signals that basically hit the wires at the same time. First, we've got a jaw-dropping report from the banking giant Citi. And second, an almost alarming interview with James Emmett, the CEO of MKS PAMP.
Okay, so for anyone listening who doesn't, spend their weekends reading Swiss refining brochures, who is MKS PAMP?
They're giants. I mean, truly one of the world's largest precious metals refiners. They're the ones actually melting the stuff down, casting the bars that end up in vaults in factories.
So you have Citi on one side representing the paper market, the traders, the futures contracts.
And then on the other side, you have MKS PAMP. They are the physical market, the actual metal.
And yesterday, they both started screaming the exact same thing.
Exactly.
So our mission today is to figure out why this boring metal has doubled in value, why a bank is now predicting a 50% price surge in just 90 days, which just sounds insane, and what this whole air freight thing tells us about the global economy.
It's a fascinating case study. It's basically supply and demand 101 running headfirst into a structural deficit that, frankly, nobody seemed to prepare for.
All right, let's get into the numbers because they're startling. We have to start with the Citi report. Bank research notes are usually so dry. They say something like, we see a moderate upside of 4%. Very safe.
Oh, yeah, very hedged. But not this time. They just tossed the rule book out. They raised their 0 to 3 month price target for silver from $100 an ounce.
$100 to what?
To $150.
Oh, hold on. 150?
150.
That's a 50% increase in 90 days.
Right.
That sounds like a prediction you'd hear from some guy on YouTube, not a global bank. That feels incredibly aggressive.
It's incredibly aggressive. I mean, you have to understand, banks hate looking foolish. If they predict 150 and it stays at 100, they lose massive credibility. So for Citi to put that number in writing for a 3-month window, it tells you they're seeing something urgent.
So what are they seeing?
They operate in the futures markets. They're looking at client flows, at positioning. And what they're seeing is what they call physical tightness. They're essentially warning their clients, look, if you are short silver right now, if you're betting the price will go down, you are standing in front of a freight train.
They're basically saying, get out of the way.
Get out of the way or you are going to get run over. It's a warning about a potential short squeeze on a massive scale.
Okay, so that's the Wall Street view, the view from the trading terminals. But charts are one thing, reality on the ground is another, and this is where that interview with James Emmett comes in.
Right. James Emmett, CEO of MKS PAMP. He's not looking at a spreadsheet. He's looking at his loading dock.
Yeah.
And his quote to Bloomberg was stark. He said, "There's immense silver demand in a way that we've really not seen before."
In a way that we've not seen before. We hear phrases like unprecedented demand all the time in marketing. Does it? Does it really carry weight coming from him?
It does, 100%. The commodities world is usually a slow-moving beast. Industrial demand might tick up or down a few percent a year. For the CEO of a major global refiner to say that, it implies a step change. It's not a gradual increase. It's a shock.
And the timing is just a coincidence.
Not at all. You have the paper market, Citi, and the physical market, the refiners, validating the exact same story on the same day. It's a true convergence.
And this brings us to that detail that I just found mind-blowing, the air freight situation. In the interview, Emmett says they're now flying silver instead of shipping it. I mean, why is that such a catastrophic signal? I get packages by air all the time.
It all comes down to the physics and the economics. Silver is dense, it is heavy. Historically, you put it on a ship because ocean freight is incredibly cheap. It takes a few weeks, sure, but the cost per ounce is negligible.
Right, it's the slow and cheap method. It just makes sense.
Exactly. Now compare that to air freight. Flying heavy metal bars across the planet costs multiples more. You're burning jet fuel to keep bullion in the sky. No CFO signs off on that unless the alternative is way, way worse.
So you only pay that premium when urgency trumps cost.
Correct. And Emmett's exact words were, now you simply can't wait for containers to drift across the ocean that long.
Drift across the ocean. Wow, that really paints a picture. You can just see these buyers tapping their watches, sweating.
It implies the supply chain is, for all intents and purposes, broken. It's an admission that physical availability is the bottleneck. It's not about the price anymore.
It's about possession.
It's about getting the metal in your hand before somebody else does.
Let's play that out. So if I'm making solar panels and I need silver paste for those panels to work and I run out.
Your factory stops. Your billion-dollar production line just grinds to a halt. The cost of stopping that line is astronomically higher than the cost of jet fuel. So you pay the air freight. You absorb it. You panic buy.
It sounds like the toilet paper shortages during the pandemic, but for a heavy industry.
That's a really good analogy. And Emmett added another layer here, India. He said massive flows of silver are heading to India, which is squeezing the whole global market even more.
So you've got this giant vacuum cleaner in the East sucking up all the inventory.
And everyone else is just scrambling for what's left.
Okay, so we have banks panic-adjusting targets, refiners putting metal on airplanes. Let's zoom out. How did we get here? This didn't just happen yesterday, did it?
No, not at all. The pressure has been building for over a year now. If you look at the stats, silver doubled in value in 2025. That was its best annual performance since 1979.
The best year in 46 years.
46 years. And we're only in late January 2026.
And so far this year.
It's up another 50%. On Monday, just 2 days ago, silver hit an all-time high, above $117 an ounce.
117. I remember when people are arguing if it could break 30, it feels like a different planet.
It's a different paradigm. We're seeing volatility come back with a vengeance.
Here's something I've always wondered. Gold is at record highs too, but it feels calmer. Why is silver doing backflips while gold is just sort of taking a brisk walk?
It comes down to the size of the room. We call it the liquidity gap.
Hmm.
Gold is a massive, deep market. The daily turnover for gold in London is about 5 times that of silver. Think of gold like a huge cruise ship. It takes a lot of energy to turn it.
And silver is?
Silver is a speedboat with a Ferrari engine. It's a thin market. It takes way less capital to create explosive price moves. So when all this money decides it wants precious metals exposure and it floods into silver,
The price just goes vertical.
there just isn't enough metal to absorb that much capital without a violent move up.
The expert in our notes called it the high beta substitute effect. Can we translate that?
Sure, it's basically institutional FOMO, fear of missing out. Investors see gold rallying, maybe they feel they missed the boat, so they look for a substitute, they pile into silver. But because the silver market is so much smaller, that money acts like a tidal wave in a swimming pool.
So what does this all mean for the bigger picture? Because this feels like it's about more than just a metal. Emmett mentioned a devaluation trade.
Yeah, that's the macro view. His belief is that big money is fleeing bonds and currencies, fiat money, and moving into hard assets.
Mhm.
When people lose faith in the purchasing power of their money, they buy tangible things, gold, silver, land.
The get me out of paper and into something real trade.
That's it. And the technical support this. The sources point to a golden cross. That's a classic bullish signal that brings in all the trading algorithms.
Okay, I have to play devil's advocate. I'm listening to this and it sounds like a one-way trip to the moon. But markets don't go up in a straight line. What could go wrong here?
That is the most important question you can ask. And the sources outline a few very real risks. The first one is just volatility. We just said silver is a speedboat. Well, speedboats can capsize.
Right. The elevator up, the window down.
Exactly. Silver can spike 20% in a week and then give back 15% in 2 days. You have to have a stomach of steel.
And what about the economy? If we hit a recession, doesn't demand for silver just dry up? Over half of it is used in industry.
That's the traditional logic, absolutely. A hard recession should hurt silver. But there's a counter-argument that's pretty specific to our time.
Which is what?
The green transition. So much of modern silver demand comes from solar panels and electric vehicles, and that demand is policy-driven. Even in a recession, governments are likely to keep stimulating the economy by building out the green grid, so that demand might be stickier than, say, demand for jewelry.
That makes sense. But it's still a risk.
A significant risk.
Yeah.
And then there's the Fed. If interest rates stay high, that usually hurts metals. Why hold a silver bar that pays you nothing when a T-bill pays you 5%?
Yeah. But the source mentioned real yields.
Right. It's the interest rate minus inflation. If the bank pays you 5%, but inflation is 6%, your real yield is negative 1%. You're losing money. And if inflation stays sticky, real yields could stay low or negative. And that is historically rocket fuel for metals.
Okay, here's the other big question I think people have. If the price is 117 and Citi thinks it's going to 150, why don't the mines just, dig up more?
In farming, that works. In mining, absolutely not. You can't just flip a switch. Developing a new mine can take 5 to 10 years. You have permits, exploration, construction.
So we're looking at a 5 to 10 year lag time for any new supply.
Correct. And recycling is already factored in. There is no quick fix for a structural supply deficit. We're using silver faster than we can get it out of the ground.
And that leads us to maybe the most complex but also most important part of this, the structural shift.
Yeah.
The paper versus physical battle.
This is the crux of the whole thing.
Explain this, because most people just see the price on their phone app and assume that's the price.
For decades, the price has been set by the paper market futures contracts on exchanges like the COMEX. Millions of ounces are traded on paper for every 1 ounce that actually moves.
So the bankers and algorithms decide the price, and the physical buyers just have to pay it.
Historically, yes. But that system only works if there's enough physical metal to back it up. What happens when the paper price says $100, but you physically cannot get the metal delivered at that price?
The screen price becomes a suggestion, a fiction.
A fiction, exactly. We're seeing the paper market lose its grip. When buyers have to start using airplanes, they stop caring what the futures price is. They'll pay whatever it takes.
And that's where Citi's 150 target comes from.
I think so. I interpret that not just as a guess, but as them pricing in the risk that the paper price has to violently chase the physical reality higher. The tail is no longer wagging the dog.
The actual metal is taking charge.
It is. The market is finally realizing, oh wait, this is a finite resource. And an indispensable one. You can't make a solar panel without it. There's no easy substitute.
So Citi is basically saying the old rules are out the window.
In a nutshell, yes. They're seeing the physical reality and the trader momentum creating a powerful feedback loop.
This has been a wild ride. Let's try to summarize this. We're looking at a market where a major bank is predicting a 50% price jump in 90 days. At the same time, a top refiner says demand is unprecedented, and they're flying metal on planes because the supply chain can't keep up.
That's the core of it. Whether you're an investor or just an observer, this is a live lesson in economics. We're watching a market transition from abundance to a structural deficit.
And it's not just about speculation, it's about utility. We need this stuff.
We do. And the risks are real. The volatility will be extreme. But the underlying signal from the bank and the refiner, it tells us something fundamental has shifted.
It makes you look at the electronics in your pocket a little differently, doesn't it?
It certainly does. It's not just a shiny rock anymore. It's a strategic asset.
Before we sign off, I want to leave everyone with one final thought. We talked about this transition from a paper-dominated market to a physical-dominated one. For 40 years, the price of silver was whatever a trader in New York said it was on a screen. But if that paper price is no longer the real price because you can't actually get the metal fast enough, then what is the actual value of the metal in your pocket?
That's the multi-billion-dollar question, isn't it? When the screen disconnects from reality, the only price that matters is what someone is willing to pay to hold it in their hand.
Thanks for diving deep with us. We'll be watching that 150 target very closely. Catch you on the next one.
Take care.